Nasdaq 100 futures slid on Thursday evening after Intel issued an outlook that fell short of Wall Street's expectations. Futures linked to the tech-heavy index shed 0.5%. S&P 500 futures dropped 0.2%, while Dow Jones Industrial Average futures slipped 81 points, or 0.2%. In after-hours trading, Intel's stock price sunk 10% after the chip manufacturer posted disappointing fiscal first-quarter guidance for the top and bottom lines. Semiconductor stock KLA Corp slid more than 5% after the company posted light revenue and earnings per share guidance for its fiscal third quarter. During the regular session, the S&P 500 leapt to a fresh all-time high. The broad market index and the Nasdaq Composite posted gains for the sixth straight day and overcame significant drag from Tesla shares, which slumped more than 12%. The S&P 500 advanced 0.5%, and the Nasdaq ticked up by 0.2%, while the Dow added 0.6%. The major averages are also tracking for a winning week. The S&P 500 is up 1.1%, while the Dow has added 0.5%. The Nasdaq is the outperformer of the three, pacing for a 1.3% jump. Stock's steady gains were buoyed by encouraging economic data released on Thursday. Gross domestic product data revealed higher than expected economic growth in the fourth quarter, piling onto investors' hopes that the economy has avoided a deep recession. Additional inflation data is on deck, with December's personal consumption expenditures price index due Friday morning. The PCE is a preferred inflation gauge for the Federal Reserve, and the outcome could inform the central bank's upcoming policy decision. Economists polled by Dow Jones expect that core PCE prices gained 3% in December on a year-over-year basis. Companies reporting earnings on Friday include Norfolk Southern, Colgate-Palmolive and American Express. Proactive investors will want to switch out of their cash-heavy positions now and get into bonds before the Federal Reserve begins cutting rates, said UBS's Mark Haefele. The 100 largest money market funds are still yielding well over 5%, but those rates will come down as the Fed trims rates. Haefele, Global Chief Investment Officer for Wealth Management, said that in its base case UBS expects 8.5% returns for high-quality medium-duration bonds, compared to 4.3% for cash. Another reason to go for longer-term fixed income. In a hard landing situation, portfolio losses would be cushioned by those bonds. In a recession scenario, UBS anticipates equity markets could tumble more than 15% on a total return basis, but those losses would be curbed by a 16% rally in bonds. A portfolio that is allocated 60% towards stocks and 40% in bonds would see just a 3% decline in this circumstance, Haefele said. Investors holding excessive cash would not be as well insulated in this scenario. Cash does not rally, and the returns on rates would likely fall in this scenario, he wrote.